Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff published on Sunday night this week his playbook, which can be found on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance to stay on top of our content. Jeff, welcome back, sir.
Hey, great to be here, Mehdi.
So, it feels like a bit of a cautious market right now. Not really sure if I have anything to throw in there. I'd like to listen to the experts. So why don't we dive right in and listen to a top down?
Sure. Well, let me start by saying that we published our monthly investment newsletter on Saturday, June 3rd, as we do the first Saturday of every month. It's Huge Insights, the Big Picture. And that's available on Substack, as you mentioned earlier. We cover a lot and in great detail what's going on in this, AI hysteria, if you will, and kind of look at it from a historical perspective as well as what the future might hold. It's definitely worth taking a look at. We also go into great detail about how we get to where we are in our current forecast. So let's start with that. We think the market's topping. We think it's topping kind of in line with where we peaked on Friday on a closing basis and yesterday's intraday high. We think we're within something like, say, 25 points of the top, if we're not there already. We put out a few levels, and we'll talk about that in a little bit. But our sense is that primary wave 2 has topped or is topping and will top very near within 25 points on the S&P, and that's going to be the big turning point. We think the next leg down will begin from this level, and it could carry the S&P meaningfully lower to new bear market lows. And so, we'll talk about the details in a second, but, we continue to advise our subscribers to be patient, to, minimize net equity exposure, maximize cash reserves right now. Why not? You're getting paid 5.5% in 3 to 6 month T-bills, risk-free. We think it's a fat pitch, and we think investors should embrace it.
It certainly does feel like a tough one to pass up 5.5% risk-free. Caution is there to be had. So a lot of these bullish pundits are saying that last week or the end of the last week's rally was much more broader based and not as tight as peak things may have seemed. You definitely disagree with this, right?
Well, I don't disagree with the fact that we saw some broadening out on Thursday and Friday, but I disagree with the notion that it's a big change. It's not the massive breadth thrust that I was reading about on Twitter over the weekend. And when we think about a breadth thrust and breadth, it's the participation in the market, the breadth of participation, right? And what we've seen is an extremely narrow advance that's been held up by 10 stocks, basically. In fact, I read over the weekend on Bloomberg that 10 stocks were up 8.9% in May, and the other 490 were down 4.3%. And that's how we got to like the 0.25% positive, return that we saw in May. So when we think about what's going on here, we think there's a total misapprehension about market breadth, and what it really means is that sustained broad market participation is the empirical evidence of institutional buying. We are not seeing that in the S&P 500 right now. If anything, institutions are backing away from the market. We're seeing retail carry this with a lot of options participation in these top 10 stocks. What we saw on Thursday and Friday was an oversold bounce, maybe even a dead cat bounce in sectors like REITs, materials, industrials, healthcare, financials, all of which were decimated in the month of May. So it makes sense that the shorts maybe decided at this point that enough is enough. They covered. We got some follow through. And I think, of course, the big pop on the debt ceiling deal, is probably what drove it. But if we take a look a little bit deeper at the advanced decline line data for the S&P 500, not the broader market, but just the S&P, we can see that we're nowhere near the April highs, never mind the February highs, right? And that tells me that negative divergence in terms of the number of cumulative net advancers relative to declines, is not keeping up with price, right? That negative divergence suggests that there's some internal weakness in the market. And you can see it even more clearly when you look at the ratio of the S&P equal weight index divided by the S&P cap weight index. And we're in a very, very steep downtrend. And while, yeah, we hit a low last week and bounced a little bit, we came nowhere near even tagging the trend line, let alone penetrating it. So, I think that bottom frame of the chart really illustrates the internal weakness in the market right now. And we suspect that will continue. And if anything, we think what's likely to happen is these top 10 stocks that are kind of driving the performance of the market are going to catch up with the rest of the market on the downside.
So let's flip over to the Nasdaq. I think it's pretty fair to say there really hasn't been broad-based participation in the Nasdaq looking at this chart.
Yeah, it's even worse than the Nasdaq, Mehdi. And Nasdaq's 100. This is the Nasdaq 100 index, so it's 20% of the number of net constituents. And again, what we're looking at here is the ratio of the equal weight Nasdaq 100 with the traditional cap weight Nasdaq 100, and it posted a new all-time record weekly closing low on Friday. So 90 of the stocks in that index, they don't know that there's a bull market, right? Because the bull market is in 10 stocks, right? And so, I think that at the end of the day, we have to kind of take a look at this and walk away with the idea that the narrowness of the participation in this rally makes the entire rally very suspect. And while it could be resolved to the upside, in other words, we could see the market's participation broaden out, that's unusual in a bear market. And I believe we're still in a bear market. What's more likely to occur is that we see these top 10 participating stocks reach an exhaustion point, they roll over and they join the rest of the party to the downside.
Ouch. Well, let's have a look at this slide. This is market cap versus earnings. This is a great looking slide, and it seems like things are getting more and more concentrated here.
They are, and this is a study that we ran with about a month ago, you may recall, and it's done by Ned Davis Research. So let's give credit to where credit is due here. But we find it extremely compelling because it really illustrates the fundamental side of this story. In terms of the breadth reaching some type of a peak. When we look at the top, and they've expanded their study to include 9 stocks, including NVIDIA, Adobe, and Salesforce.com, as well as the traditional FANGs. And maybe there's another one in there I missed, but Netflix, I think. So, at the end of the day, we're kind of using a basket of stocks that's inconsistent with what we just talked about, but still, they are these tech titans, right, that they've been talking about for a long time. And what we've seen is the market cap of those leading technology stocks has now reached its past peak at around 27.5%, which we saw, a couple of times before, back in 2021, back in 2018, 19. And when it's got to that level in the past, earnings participation was much, much stronger. It was more like 22, 23% of the index, in line with kind of the weighting of the market cap. But today it's 16%. And so when we look at the ratio of the market cap weighting of these tech titans to their earnings contribution, that ratio has now reached 3 standard deviations above the mean. When we ran the study, like a month ago, it was 2 standard deviations above the mean. So we've reached a new extreme in the last 12 years or whatever we're looking back at. And why is that 12 years and not longer? Well, a lot of these stocks didn't exist before then. Meta, for example. What I would say is that we're looking at a pretty interesting convoluted market where we've gotten so stretched, and it's all been PE based. In other words, the entirety of this rally has been driven on multiple expansion, not earnings and revenue growth. NVIDIA's revenues were down over 13% last quarter, year over year. So that's not the reason the stock's up. The stock's up on bullish expectations of blowout revenues next month. Well, we'll see. Read the newsletter. You'll find out why we're skeptical about that.
Let's move on to some technicals here, Jeff. Let's have a look at a short-term Elliott wave view.
So Friday's upside gap in kind of the S&P 500 was a response to the debt ceiling deal in Congress, right? It was good news. The market gapped up to a new, intraday and daily closing high, right? And we kind of forecasted that. If you look back to our May 19th publication and, our presentation on your show, we talked about how we expected to see a big upside move in the S&P 500 to, probably challenge that resistance level at Fibonacci 61.8% retracement of the entire primary wave one decline, which we marked at the October low. Well, what we saw was a move up through yesterday's intraday high to about 42.99, right? Just shy of that, 13 points below the 61.8% retracement. In that area, we've got a bunch of resistance levels. We've got 43.05. There's a very small gap there. We've got Fibonacci resistance. We've also got a prior fourth wave extreme, the August 16th high at 43.25. Any of those levels or all of those levels could and should act as a magnet for price. And so we won't be surprised to see if the S&P edges slightly higher to one or all of those levels. But we think that will be the top. And we're looking for this counter trend advance in primary wave two to top right in this range and roll over hard down. And if we're right, primary wave three down should carry the S&P 500 to significant new lows, new bear market lows, taking out the October lows, that is. And we think that the most likely stopping point for primary wave three would be around 2750 on the S&P 500. But there's some leeway there. It could overshoot. We could see it carry as far down as, say, 2400. Now, that being said, that's not the end of the decline that we forecast. We'd be looking for another modest counter trend advance, probably a lateral consolidation of sorts, and then a final plunge in primary wave five down that should carry the S&P to around 2250 before cycle wave A is complete. Now, that might sound a little extreme, right? It might sound like hyperbole, but what we have been forecasting, Mehdi, as you know, is we've been discussing our supercycle Elliott wave thesis. And that supercycle thesis really builds off the idea that the January 4th, 2022 high ended supercycle wave three, a 90-year advance that began back in 1932. And if that's correct, we should see a three-wave corrective waveform trace out at supercycle degree, meaning proportionate to that 90-year advance. And we expect this corrective process to take years to completely unfold. We're just simply looking at wave A down, the first of that ABC sort of corrective waveform. That will be followed by a counter trend advance of some significant proportion, which could retrace upwards of, say, 1/3 to 2/3 of the entire decline that we're looking for into that S&P 2250 level. And then once that counter trend advance tops, which again could take years to unfold, many will call it a new bull market, but it won't be. It will just simply be another counter trend. It will be followed by another quote unquote bear market that will carry prices to new lows. We think that level could be somewhere in, say, the S&P, 1,000 to 1,1400 range before it's all complete. So, it's a big picture view, but it's based on the long-term cycle of the market. And that market cycle tends to have large degree proportions. And we're at one of those turning points now. Many people think the bear market's over. We think it's just beginning. So that's our view on the market.
Well, Jeff, I normally sit here and complained that you're throwing out 2250, but you've taken that to the next level today. So I've certainly, all the hairs on my neck are spiking up right now. So a lot to digest there and keep an eye on. So you heard it here first. Jeff, let's have a look at our I can't even speak anymore. Our magnificent seven. It feels like they're losing steam as well. They've been running this bull market so far.
Yeah, oddly, with the big spike in prices last week, we saw underperformance from some of the biggest AI plays, including NVIDIA, Microsoft, and Google, all of which underperformed the S&P 500 last week. Now, on the flip side of that, Tesla was up 10%. So, maybe money was just rotated internally within that magnificent seven. Which, by the way, was coined by Bank of America, and I thought it was brilliant. We've kind of commandeered it as kind of a term that we're embracing. So you'll see it more frequently in our work, no doubt. But one of the things that I would have to say about these stocks is you're starting to see a downtick in the momentum of the advance within these names, and that is how it begins. We saw the same thing happen back in March of 2000 when the dot-com boom started to peter out. We saw fewer and fewer stocks beating the index, and until it came down to just less than a handful. And then the next big move down, and I recall this very well. I came back from a big lunch meeting, and the Nasdaq 100 was down 700 points. Okay, people think it can't happen. It can happen just like that. And that's what we expect.
Yeah, Jeff, are we seeing a bit of a bounce in the small mid-cap names as well?
Yeah, I would call it more of a dead cat bounce. We think it's more of an oversold bounce. What we've seen throughout the year is that small caps, mid caps, the equal weight indexes have all underperformed dramatically, right? And what we saw last month in May was that these indexes, including the microcap indexes, were down pretty significantly, 4, 5, 6% across the board, small, mid, microcap, et cetera. And the idea here is that the shorts are exhausted, right? They are covering, they're taking some of their profits, and that showed up in the 2-day bounce that we saw Thursday and Friday last week, where led by mid caps, small caps, micro caps, the market rebounded. We don't think that's going to carry forward, and we didn't see any follow through in the small cap side of things yesterday. So I suspect it's going to be more of the same today and going forward, especially as we start to see the momentum peter out in that magnificent seven bunch that we just talked about.
All right, so Jeff, what do we do? Let's have a little step back here and look at things from a bigger picture, right? So there's been a visible rotation in sector leadership here. Can you talk us through some of this as well, please?
Yeah, so I would say that the rotation that we're seeing has happened already, right? So we saw money rotated into tech, it rotated into comm, it rotated into discretionary. In fact, if we look at it purely on a sector rotation study basis, okay, and this is a relative strength algorithm that actually looks not just at the relative strength ratio of these sectors versus the benchmark index on a cap weight and equal weight basis, but it also looks at the momentum of that relative strength. And what we can see is that, while these sectors have been leading, their momentum's rolling over. And so it's concerning at this point, but still on top, if we look objectively at the studies, it's technology and discretionary that are leading the pack right now. And that means names like Microsoft, NVIDIA, Apple, Amazon, and Tesla. Really, that's where the super strength is right now. To a lesser extent, Google, Meta is still a very strong stock, but we see this starting to show evidence of weakness. On the flip side, it's been financials and REITs have been the weakest, okay? And while we have seen a bit of a bounce off the lows in those names, their relative strength rating, as well as the momentum of their relative strength, is still in negative territory. And so it's slightly less negative than it was, but we don't see a big turn occurring there. In fact, if I had to pick a dark horse sector to win the race eventually, I'd have to go with energy. Energy looks interesting to me for a couple of reasons. Number one, both on a cap weight basis and an equal weight basis, we're seeing the energy sector hold above its 52-week lows. That is key because the bearish side of the equation are plumbing those 52-week lows. The bulls are making new 52-week highs, but energy's holding in there, right? The other thing is we are seeing the momentum of relative strength bottom and turn up. And in the case of the cap weight side, we're starting to see positive momentum of relative strength. It hasn't shown up in the equal weight side yet, but we expect that to follow in the not too distant future. So, again, if I'm a betting man, I'd have to go with energy as a sector that makes a pretty big comeback in the back half of the year. That's where I'd be putting my money.
Great, thanks for that, Jeff. And for the most part, we're all betting men, aren't we? Really? So,
yes, we are.
Let's go with energy. Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights.
Always a pleasure, Mehdi. Thanks for having me on the show.
And I want to thank our viewers and urge you to check out Jeff's content on Substack. It's at hugeinsights.substack.com. Until next time, good luck investing.